There are institutions more powerful than most governments that control the money in your pocket right now, and you've probably never heard their names. They don't appear on the news, they're not on any ballot, but their decisions can make your salary worth half its value overnight. They operate in the shadows, making choices that affect billions of people, and nobody elected them, nobody can fire them. Today you're going to discover who really pulls the strings of the global economy, and I guarantee what you learn in the next 20 minutes will fundamentally change how you see the financial world. When you think about who controls money, you probably think about your government, the president, Congress, the Federal Reserve maybe. But the reality is far more complex and frankly far more fascinating than most people imagine. There's an entire network, an entire architecture of international institutions operating in the shadows of the global financial system. These organizations make decisions every single day that affect billions of people, and they do it without being accountable to any voter anywhere in the world. I've spent more than 2 decades studying the international financial system. I've worked with central banks, consulted for financial institutions, and I've seen firsthand how these mechanisms operate behind closed doors. And I can tell you with absolute certainty that what I'm about to reveal today will completely transform the way you understand how money really works in the modern world. You're going to see the matrix, so to speak, and once you see it, you can never unsee it. Get ready, because this journey into the hidden architecture of global finance is going to surprise you, shock you, and maybe even disturb you a little bit. And here's something that's going to absolutely freeze your blood. There's an institution in Switzerland, a building in Basel, where the world's most powerful central bankers meet every 2 months. The heads of the Federal Reserve, the European Central Bank, the Bank of Japan, the Bank of England, all gather in this tower. And what they decide in those meetings behind closed doors can trigger economic crises that destroy millions of jobs or create financial bubbles that explode years later, taking down entire economies. Nobody elected these people. Nobody can fire them. But they control more money than the gross domestic product of most countries on Earth. Stay with me, because I'm going to explain exactly how this invisible power works and why you should care deeply about it. Let's start with the most mysterious and arguably most powerful institution of all, the Bank for International Settlements, known as BIS. Now, this bank is located in Basel, Switzerland, and it was founded in 1930 originally to handle World War I reparations payments. But it evolved into something far more significant, far more powerful. This is not a bank where you or I can open an account. This is not a bank that serves the public. It's the bank of central banks. It's where central bankers from around the world coordinate their activities. Imagine this scenario. Every 2 months, like clockwork, the governors of the world's most important central banks board private planes and fly to Basel. We're talking about the chairman of the Federal Reserve, the president of the European Central Bank, the governor of the Bank of Japan, the governor of the Bank of England, the heads of the central banks of Switzerland, Canada, and dozens of other countries. These are the most powerful unelected officials in the world. And they meet in a tower in Basel for what they call the Global Economy Meeting. These meetings are absolutely confidential. There are no journalists allowed. There are no cameras. There are no public minutes of what's discussed. No transcripts. Nothing. The most you'll get is a bland press release that says something generic like, "Central bank governors discussed global economic conditions and monetary policy coordination." That's it. But behind those closed doors, these people are coordinating the monetary policies that will affect every person on planet Earth. And here's the incredible part that most people don't know. The BIS has legal immunity. It cannot be sued in any court. Its archives and documents cannot be seized by any government. Its buildings cannot be entered by police or security forces, even in Switzerland where it's located. And its executives and the central bankers who attend meetings there have diplomatic immunity similar to ambassadors. They literally cannot be arrested or detained. Think about that for a moment. An institution that controls hundreds of billions of dollars and coordinates global monetary policy operates above the law. The BIS handles transactions worth hundreds of billions of dollars every single day. It facilitates currency exchanges between central banks. When the Federal Reserve needs to exchange dollars for euros or yen, it often does it through the BIS. The BIS manages gold reserves for many countries. In fact, it holds more gold than almost any institution on Earth. And it establishes the banking regulation standards that are then adopted by virtually every country in the world. You've probably heard of the Basel Accords. Basel I, Basel II, Basel III. These are the international standards that determine how much capital banks must have to operate, how much risk they can take, what kind of reserves they need to hold. Where do these standards come from? They come from committees housed at the BIS. Unelected technocrats and central bankers meet in Basel, and they decide the rules that every bank in the world must follow. And if your country doesn't follow these rules, your banks get shut out of the international financial system. So countries comply. But here's something even more fascinating. The BIS is technically a private company. It's organized as a corporation. It has shareholders, though those shareholders are the central banks themselves. It operates for profit and generates earnings every year. Those earnings are distributed to its shareholders' central banks. It's a hybrid entity that's neither completely public nor completely private. It's not quite a government institution, but it's not a normal private company either. And that ambiguity, that legal gray area, is precisely what gives it so much power. It can operate without the transparency requirements of a government agency, but it has the authority and reach of an international governmental organization. During the 2008 financial crisis, while governments around the world were panicking, while presidents and prime ministers were scrambling, the BIS had actually warned years earlier about the risks that were accumulating in the financial system. Back in 2003 and 2004, the BIS was publishing reports saying that there was too much debt in the system, that housing prices were inflated, that derivatives were becoming too complex and risky. But nobody listened. The good times were rolling. Banks were making record profits. Governments didn't want to rain on the parade. And when everything collapsed in 2008, when Lehman Brothers went bankrupt, when AIG had to be rescued, when the entire global financial system was on the brink of total collapse, the BIS was fundamental in coordinating the global response. It facilitated emergency credit lines between central banks. It helped coordinate the massive bailouts and stimulus programs. It brought together central bankers to make sure they were all on the same page. Without the BIS, the crisis could have been even worse. But here's the question we have to ask. Who gave the BIS this power? Who decided that unelected central bankers should meet in secret and coordinate policies that affect billions of people? The answer is that the central banks themselves created this system. It's a self-perpetuating elite. The most powerful financial officials in the world created an institution to coordinate their own power. And they did it in a way that insulates them from democratic accountability, from public scrutiny, from the messiness of politics. They operate in the shadows by design. Now let's talk about an institution that you've probably heard mentioned, especially if you follow international news or if you live in a developing country. The International Monetary Fund, or IMF. This organization was created in 1944 during the Bretton Woods Conference, right at the end of World War II. The world was in ruins. The Great Depression had devastated economies. The war had destroyed infrastructure. And the leaders of the Allied powers, primarily the United States and Britain, gathered in Bretton Woods, New Hampshire, to design a new international economic order. The IMF was created with what seemed like a noble purpose: to promote international monetary cooperation, to facilitate international trade, to promote exchange rate stability, and to provide temporary financing to countries with balance of payments problems. It all sounds very benevolent, very technical, very boring even. But the reality of how the IMF operates is far more controversial and far more political than that dry description suggests. The IMF today has 190 member countries. And its main function, its primary reason for existing, is to lend money to countries that are facing economic crises. When a country is running out of foreign currency reserves, when it can't pay its debts, when its economy is collapsing, the IMF steps in as the lender of last resort. It provides emergency financing, billions of dollars, to keep the country afloat, to prevent default, to stabilize the economy. Sounds helpful, right? Sounds like a good thing. But here's where things get interesting and deeply controversial. When a country needs money from the IMF because it's on the brink of bankruptcy, the fund doesn't simply hand over the money, no strings attached. Oh no. It imposes what are called conditionalities. These are economic reforms, structural changes that the country must implement to receive the loan. And this is where the real power of the IMF becomes apparent. This is where an international institution that's not accountable to voters in any country can effectively dictate the economic policies of sovereign nations. What kind of conditionalities are we talking about? Well, they typically include deep cuts to government spending, privatization of state-owned enterprises, liberalization of trade, removing tariffs and trade barriers, reduction or elimination of subsidies on food, fuel, and other essentials, labor market reforms that make it easier to fire workers and reduce worker protections, increases in taxes, especially regressive taxes like value-added taxes that hit poor people hardest, devaluation of the currency, which makes imports more expensive and reduces people's purchasing power, and opening up the economy to foreign investment, often allowing foreign companies to buy up domestic assets at fire sale prices. The theory behind all of this is called neoliberal economics, or sometimes the Washington Consensus. The idea is that these market-oriented reforms will make the economy more efficient, more competitive, more attractive to investors, and that in the long run this will lead to growth and prosperity. That's the theory. But what happens in practice? What actually happens when the IMF imposes these conditionalities on a country? Well, we have decades of evidence now, and the track record is mixed at best and disastrous at worst. What typically happens is that millions of people lose their jobs. Public services, healthcare, education, infrastructure all deteriorate because of budget cuts. Poverty increases dramatically, often doubling or tripling in just a few years. Inequality explodes as the wealthy who have assets and foreign currency can protect themselves while the poor and middle class get crushed. And frequently these policies lead to social unrest, protests, riots, sometimes even the overthrow of governments. Let me give you some concrete examples. Argentina in the 1990s and early 2000s. The IMF prescribed a whole menu of reforms. Argentina followed them to the letter. Privatized everything, cut spending, opened the economy. And what happened? The economy collapsed anyway. In 2001 and 2002, Argentina experienced the worst economic crisis in its history. Unemployment hit 25%. Half the population fell into poverty. The government defaulted on its debt. There were riots in the streets. People died. And the IMF policies were widely blamed for making the crisis worse. Or take Greece in the 2010s. During the European debt crisis, Greece needed bailouts from the IMF and European institutions. The conditions imposed were brutal. Massive austerity, pension cuts, tax increases, privatizations. The Greek economy contracted by 25%. That's a depression. Youth unemployment hit over 50%. An entire generation was devastated. Suicide rates increased. Public health deteriorated. And even the IMF itself later admitted that it had miscalculated, that the austerity was too harsh too fast. We can look at dozens of countries in Africa that have been under IMF programs for decades. Zambia, Malawi, Kenya, Uganda, Tanzania, and many others. The promised growth and development never materialized for most people. Instead, these countries got trapped in cycles of debt and dependency. They borrowed from the IMF, implemented painful reforms, borrowed more, implemented more reforms, and never managed to achieve sustainable development. Now, the IMF would argue that these countries were already in crisis when they came to the fund. That the policies were necessary medicine, even if bitter. That things would have been even worse without IMF intervention. And there's some truth to that. Countries don't go to the IMF when things are going well. They go when they're desperate. But the question is whether the IMF medicine helps or hurts. And the evidence suggests that in many cases it hurts, at least in the short to medium term. And here's something crucial that you need to understand about the IMF. It's not a democracy. Not even close. The power structure at the IMF is based on money. Each country's voting power is determined by how much money it contributes to the fund. The United States has about 17% of the votes, which gives it veto power over major decisions. The European countries together have another large block of votes. Japan has a significant share. China's share has been increasing but is still relatively small compared to its economic size. What this means is that the United States and Europe collectively control the IMF. They have the votes to determine who becomes the managing director of the IMF, what policies the fund adopts, which countries get loans, and under what conditions. And naturally, when you have this power structure, the policies tend to favor the interests of the rich countries and the large international banks and corporations that operate out of those countries. Meanwhile, all of sub-Saharan Africa combined has less voting power than Belgium. Think about that. An entire continent with over 1 billion people has less say in IMF decisions than one small European country. Latin America, despite being home to over 600 million people, has less combined voting power than the United States alone. This is why critics call the IMF a tool of American and European imperialism, because effectively it is. It's a way for the rich countries to impose their preferred economic model on the rest of the world. The IMF also plays another crucial role in the global financial system through something called special drawing rights, or SDRs. This is essentially a virtual reserve currency created by the IMF. Countries can exchange SDRs for dollars, euros, yen, yuan, or pounds. During times of crisis, the IMF can create new SDRs out of thin air, kind of like how central banks create money and distribute them to member countries. During the COVID-19 pandemic, the IMF created $650 billion worth of SDRs to help countries deal with the economic fallout from the lockdowns and the health crisis. Sounds great, right? But here's the thing. The distribution of SDRs is done according to each country's quota at the IMF, which is based on the voting shares we just talked about. So the majority of those $650 billion went to the richest countries that needed it least. The United States received about $113 billion. European countries received huge amounts. Meanwhile, the poorest countries in Africa that were most desperate for help received tiny amounts. This is the fundamental injustice built into the structure of the IMF. It's supposed to help countries in need, but it's controlled by countries that are already rich and powerful. And those countries naturally use that control to advance their own interests. The IMF also has enormous influence over market confidence and investor behavior. When the IMF approves a program with a country, when it gives its stamp of approval, international investors see that as a green light. They interpret it as a signal that the country is doing the right things, implementing sound policies. And money starts flowing in. Conversely, when the IMF criticizes a country or threatens to withdraw support or actually does withdraw support, investors panic and flee. Capital flight happens. The currency collapses. Interest rates spike. And the country can quickly spiral into crisis. So the IMF has this incredible power to essentially determine which countries get access to international capital markets and which don't. And it exercises this power without being accountable to the people who are most affected by its decisions. It's accountable to its shareholders, the rich countries that control the voting shares. It's not accountable to the billions of people in developing countries whose lives are turned upside down by IMF-mandated austerity programs. Before we continue, let me ask you something. Is this content opening your eyes about how the global financial system really works? Are you starting to see the hidden architecture of power that most people never learn about? If so, I want to invite you to subscribe to this channel right now and hit that notification bell. Every single week I upload in-depth content that helps you understand the invisible mechanisms that control the economy and your money. We dive deep into topics that mainstream media barely touches. We connect the dots that others miss. Don't let this be the last time you get this level of insight. Subscribe now so you don't miss the next video where we're going to go even deeper into these rabbit holes. Trust me, you're going to want to follow this journey. Now let's talk about the IMF's twin sibling, the World Bank. These two institutions were born together at Bretton Woods in 1944, but they were designed to have different though complementary functions. While the IMF focuses on short-term financial stability and balance of payments crises, the World Bank was created to finance long-term economic development projects. The official name is actually the International Bank for Reconstruction and Development. It was originally designed to help rebuild Europe after World War II. But once Europe recovered, the bank shifted its focus to what were then called third world countries, now referred to as developing countries or emerging markets. Today, the World Bank Group includes several related institutions with slightly different mandates, but the core mission is to reduce poverty and promote economic development by financing projects in poor countries. On paper, this sounds wonderful. The World Bank finances infrastructure projects, roads, bridges, ports, airports. It finances power plants and electrical grids. It finances schools and hospitals. It finances agricultural development projects. It provides technical assistance and expertise to governments. It conducts research on development issues. Over the decades, the World Bank has financed tens of thousands of projects in virtually every developing country on Earth. It has helped millions of people gain access to electricity, clean water, education, healthcare. But just like with the IMF, there's another side to this story. A darker, more controversial side that you need to understand. Because World Bank projects don't just bring benefits. They also frequently come with serious costs. Environmental costs, social costs, human costs. Let's start with the structural issue. World Bank loans, just like IMF loans, come with conditions. The bank doesn't just finance a highway or a dam and leave it at that. It uses its financing as leverage to push countries to implement broader economic reforms. Trade liberalization, privatization, deregulation, market-oriented reforms. The same Washington consensus package that the IMF pushes. So you get this 1-2 punch. The IMF comes in during a crisis and imposes austerity and structural adjustment. Then the World Bank comes in to finance development projects, but it also pushes the same market fundamentalist ideology. Now let's talk about some specific World Bank projects that have gone horribly wrong. The Sardar Sarovar Dam in India. This was one of the World Bank's flagship projects in the 1980s and 90s. A massive dam on the Nirmada River designed to provide irrigation and hydroelectric power. Sounds good, right? But the dam displaced over 300,000 people from their homes. Entire villages were submerged. Communities that had lived in the valley for generations were forcibly relocated. Many of the displaced people were never adequately compensated. They lost their land, their homes, their livelihoods. And the promised benefits of the dam mostly went to wealthy farmers and urban areas, not to the people who were displaced. The project was so controversial that it sparked massive protests in India. Activists, including the writer Arundhati Roy, brought international attention to the human and environmental costs. Eventually, the World Bank itself withdrew from the project because of the controversy, though the Indian government continued building the dam with other financing. Or take the Polo Noroeste project in Brazil in the 1980s. This was a World Bank-funded project to develop infrastructure in the northwestern Amazon region. The bank financed roads and agricultural settlements. The explicit goal was to relieve population pressure in other parts of Brazil by opening up the Amazon to development. And what happened? Massive deforestation. Destruction of indigenous lands. Displacement of indigenous peoples. An ecological catastrophe. The project was eventually shut down after enormous international pressure, but the damage was done. Indonesia provides another example. In the 1980s and 90s, the World Bank funded a series of forestry projects supposedly aimed at sustainable forest management. But in practice, these projects led to massive deforestation and environmental destruction. The bank's own evaluations later admitted that the projects failed to achieve their conservation goals. Time and again we see this pattern. The World Bank finances large-scale development projects, dams, highways, plantations, industrial facilities. These projects are supposed to reduce poverty and promote development. But frequently they end up benefiting wealthy elites and foreign corporations while harming poor people and the environment. Local communities get displaced. Ecosystems get destroyed. And the promised benefits never materialize for the people who are supposed to be helped. Why does this happen? Part of the reason is that the World Bank, like the IMF, is controlled by rich countries. The president of the World Bank is traditionally an American nominated by the US government. This has been an unwritten rule since the institution was created. The US gets to pick the World Bank president. Europe gets to pick the IMF managing director. That's the deal. And the bank's lending decisions and project approvals are influenced by the geopolitical interests of its major shareholders. During the Cold War, the World Bank funneled money to anti-communist regimes regardless of how corrupt or oppressive they were. Indonesia under Suharto. Zaire under Mobutu. The Philippines under Marcos. These dictators received billions in World Bank loans even as they brutalized their own people and stole vast sums of money. Because they were aligned with the West in the Cold War. Today, the geopolitical calculations are different, but they still influence lending decisions. Countries that align with US and European interests find it easier to get World Bank financing. Countries that don't find it harder. The bank claims to be apolitical, to base its decisions purely on technical economic criteria, but that's simply not true. Politics always plays a role. Another fundamental problem is the top-down technocratic approach of the World Bank. Projects are designed by economists and engineers sitting in Washington, D.C. or in regional offices. They use sophisticated economic models and technical analyses. But they often have little understanding of local conditions, local cultures, local needs. They rarely consult meaningfully with the people who will be affected by the projects. And when things go wrong, when projects fail or cause harm, there's limited accountability. The World Bank has an inspection panel where affected communities can file complaints about projects. But this mechanism has very limited power. It can investigate and issue reports, but it can't force the bank to change course or provide compensation. And most affected communities don't even know the inspection panel exists or don't have the resources to navigate the complex process of filing a complaint. Let's also talk about debt. The World Bank provides loans, not grants. Countries have to pay back the money with interest. And over the decades, many developing countries have accumulated enormous debts to the World Bank and other international lenders. These debt burdens consume huge portions of government budgets. Money that could be spent on healthcare or education instead goes to servicing foreign debt. And this creates a cycle of dependency. Countries need more loans to pay off old loans. They remain trapped in debt and remain dependent on the World Bank and IMF. There have been debt relief initiatives over the years. The Heavily Indebted Poor Countries Initiative. The Multilateral Debt Relief Initiative. These programs have canceled some debt for the poorest countries. But the amount of relief has been limited, and it always comes with conditions. Countries have to prove that they're implementing sound economic policies as defined by the World Bank and IMF before they can get debt relief. So even debt relief becomes a tool for imposing policy conditionalities. The World Bank has also faced criticism for its role in promoting privatization. In the 1980s and 90s, the bank pushed hard for privatization of state-owned enterprises in developing countries. Utilities, water companies, power companies, telecommunications companies all were sold off to private investors, often foreign corporations. The theory was that private ownership would lead to greater efficiency and better service. But what often happened was that these privatizations led to higher prices, reduced access, especially for poor people, and enormous profits for foreign corporations. The privatization of water services in Bolivia and the Philippines led to protests and riots when prices skyrocketed. The privatization of electricity in many African countries led to deteriorating service and frequent blackouts. The benefits went primarily to investors, not to ordinary citizens. Now I want to be fair here. The World Bank has financed many projects that have genuinely helped people. Roads that connected remote villages to markets. Irrigation systems that increased agricultural productivity. Schools that expanded access to education. Health programs that reduced infant mortality. The bank's work on global health issues like HIV/AIDS, malaria, and tuberculosis has saved millions of lives. Its research and data collection on poverty and development have been valuable. But we have to weigh those positives against the negatives. Against the environmental destruction, the displacement of communities, the debt burdens, the failed projects, the imposition of policies that benefit rich countries and corporations at the expense of poor people. And when we do that accounting, the picture becomes much more complicated than the World Bank's own public relations would suggest. Now let's shift gears and talk about a different kind of institution. The World Trade Organization, or WTO. This organization deals not with lending money but with regulating international trade. And it has powers that in some ways are even more dramatic than the IMF or World Bank, because the WTO can actually force countries to change their laws. The WTO was created in 1995, though it evolved from the General Agreement on Tariffs and Trade, which had existed since 1947. The basic idea is simple. International trade benefits everyone if we can eliminate barriers to trade. Tariffs, quotas, subsidies, regulations that favor domestic producers over foreign ones. If we can get rid of all that and create a level playing field, then trade will flourish and everyone will be better off through comparative advantage and specialization. That's the theory. And there's economic logic behind it. Trade can indeed create wealth and lift people out of poverty. The economic growth of East Asian countries like South Korea, Taiwan, Singapore was built on export-oriented trade. China's incredible economic transformation over the past 4 decades has been powered by integration into global trade. Hundreds of millions of people have escaped poverty because of trade. But the WTO goes beyond simply promoting trade. It has created a powerful enforcement mechanism. Here's how it works. The WTO has a set of agreements that all member countries must follow. These agreements cover not just tariffs but also subsidies, regulations, intellectual property rights, services, agriculture, and much more. If one country believes that another country is violating WTO rules, it can file a complaint. The complaint goes to a dispute settlement panel. This panel is composed of trade experts, typically lawyers and economists, appointed by the WTO. They hear arguments from both sides. They review the evidence. And then they issue a ruling. Is the country in violation of WTO rules or not? And here's the crucial part. The rulings are binding. If a country is found to be in violation, it must change its laws or policies to comply with WTO rules. If it doesn't comply, the other country can impose trade sanctions, tariffs on the violating country's exports. Now think about what this means. An international organization can force a sovereign country to change its democratically enacted laws. This has actually happened many times. Let me give you some examples. The United States had a law called the Clean Air Act that set certain standards for gasoline sold in the U.S. These standards were stricter for imported gasoline than for domestically refined gasoline. Venezuela and Brazil complained to the WTO, arguing that this discriminated against their exports. The WTO ruled in favor of Venezuela and Brazil. The U.S. had to change its Clean Air Act to treat domestic and imported gasoline the same way. The European Union had a ban on beef from cattle treated with growth hormones. Europe cited health concerns and consumer preferences. American and Canadian cattle producers use growth hormones extensively. They complained to the WTO. The WTO ruled that Europe's ban was not based on sufficient scientific evidence and was therefore an illegal barrier to trade. Europe refused to lift the ban, arguing that it had the right to apply the precautionary principle to protect its consumers. So the WTO authorized the US and Canada to impose retaliatory tariffs on European products. For years Europe paid this price in the form of tariffs on exports to the US and Canada rather than allow hormone-treated beef. Similar disputes have involved US regulations on dolphin-safe tuna labels, Thailand's cigarette regulations, Australia's plain packaging requirements for cigarettes, India's solar panel local content requirements, and many more. In case after case, the WTO has ruled that domestic regulations, even when they're aimed at protecting health or the environment, are illegal if they have the effect of restricting trade. Now the WTO would say that it's not against environmental or health regulations per se. It's only against regulations that discriminate against foreign products or that are not based on sound science. And that seems reasonable on the surface. But who decides what constitutes sound science? Panels of trade lawyers and economists appointed by the WTO, not democratically elected legislators, not health experts chosen by national governments. This has led to accusations that the WTO prioritizes corporate profits and trade over democracy, over the environment, over public health. Environmental groups have been particularly critical. They point out that WTO rules make it very difficult for countries to restrict trade for environmental reasons. You can't ban products because they were produced using environmentally destructive methods unless you can meet the WTO's strict evidentiary standards. This has limited countries' ability to address climate change, deforestation, overfishing, and other environmental crises through trade policy. Labor unions have also been critical. WTO rules don't require countries to maintain any particular labor standards. So countries can suppress wages, bust unions, prevent workers from organizing, and use these low labor costs to gain competitive advantage in international trade. There's no mechanism to sanction countries for labor rights violations the way there are mechanisms to sanction them for trade violations. This creates a race to the bottom in labor standards. The WTO also oversees the TRIPS agreement, trade-related aspects of intellectual property rights. This agreement requires all WTO members to enforce strong intellectual property protections, patents, copyrights, trademarks. This has been hugely beneficial for large corporations, especially pharmaceutical companies and tech companies based in rich countries. But it's been harmful to developing countries that need access to affordable medicines or technologies. The most notorious example was the fight over AIDS drugs in the late 1990s and early 2000s. Millions of people in Africa were dying of AIDS. There were effective antiretroviral drugs that could keep people alive, but they were extremely expensive because of patent protections. Some developing countries like South Africa and India wanted to produce or import cheap generic versions of these drugs. But pharmaceutical companies and the US government argued that this would violate TRIPS. There was a huge international campaign by activists and public health advocates. Eventually, the WTO modified TRIPS to allow compulsory licensing for public health emergencies, but only after years of delay during which millions of people died unnecessarily. The same issues have arisen with COVID vaccines. Rich countries bought up most of the initial supply. Developing countries wanted to waive patent protections so they could produce their own vaccines. Pharmaceutical companies and rich country governments blocked this for a long time. The WTO finally agreed to a limited waiver, but it was too little too late. Now let's talk about how the WTO actually makes decisions. It's supposed to operate by consensus. All member countries have to agree on major decisions. In theory, this sounds democratic. Every country has a voice. But in practice, what happens is that the US, Europe, Japan, and a few other rich countries dominate the negotiations. The real deal-making happens in small informal meetings of the most powerful countries. The smaller developing countries are often shut out or presented with fait accompli. The trade negotiations are incredibly complex. The agreements run to thousands of pages of technical legal language. Wealthy countries have large teams of expert trade lawyers working full-time on these negotiations. Small developing countries might have one or two officials trying to cover everything. They simply don't have the resources to fully understand and negotiate all the details. So they often end up accepting deals that are not in their interests. The Uruguay round of trade negotiations that created the WTO lasted from 1986 to 1994. 8 years of negotiations. African countries later complained that they didn't fully understand what they were agreeing to, that they were pressured to sign onto agreements in areas like intellectual property and services without fully grasping the implications. And once you're a WTO member, you're bound by all the agreements. You can't pick and choose. There's also the issue of non-trade concerns. The WTO agreements cover an enormous range of issues that go way beyond trade in the traditional sense. Regulations on domestic services like healthcare and education. Regulations on investment. Government procurement. Intellectual property, as we discussed. All of these are now subject to WTO disciplines. This represents a huge transfer of authority from national governments to an international body. And it was done without any real democratic debate in most countries. People woke up one day and found that their government's ability to regulate the economy had been constrained by agreements signed by trade negotiators. The WTO also has problems with transparency. Dispute settlement panels meet in secret. Documents are confidential. There's no public gallery where citizens can watch the proceedings. Decisions are made behind closed doors by appointed experts, not by elected officials. For an organization that has the power to overrule national laws, this lack of transparency is deeply troubling. In recent years, the WTO has been essentially paralyzed. Major trade negotiations have stalled. The Doha round, launched in 2001, has gone nowhere for over 2 decades. But because developing countries have become more assertive, they've demanded that rich countries reduce their agricultural subsidies and open their markets. Rich countries have refused. Without consensus, nothing can move forward. The dispute settlement system has also collapsed. The WTO has an appellate body that hears appeals of panel decisions. But the US blocked the appointment of new appellate body members, and the body ceased to function in 2019. Why did the US do this? Officially, because it was unhappy with how the appellate body was interpreting WTO rules. Unofficially, probably because the US had lost several high-profile cases and didn't like being subject to binding rulings. So we're left with this situation. The WTO still exists. Its rules are still technically in force. But its ability to negotiate new agreements and enforce existing ones has been seriously weakened. This has led many countries to negotiate bilateral and regional trade agreements outside the WTO framework. The Comprehensive and Progressive Trans-Pacific Partnership. The Regional Comprehensive Economic Partnership in Asia. The US-Mexico-Canada Agreement. These deals are fragmenting the global trading system and potentially making it less fair and less efficient. Now we need to talk about the elephant in the room. Central banks. And in particular, the Federal Reserve System of the United States, commonly called the Federal. Because while all the institutions we've discussed so far are important, the truth is that central banks, and especially the Fed, have more immediate power over the global economy than any of them. Central banks are unique institutions. They're not exactly part of the government, but they're not completely independent either. They exist in this strange twilight zone. They're typically established by legislation. Their leaders are usually appointed by elected officials. But they're deliberately insulated from day-to-day political pressures. The idea is that monetary policy is too important to be left to politicians who might manipulate it for short-term electoral gain. And what is monetary policy? Fundamentally, it's about controlling the money supply and credit conditions in the economy. Central banks decide how much money exists. They decide how easy or difficult it is to borrow money. They do this primarily by setting interest rates and by buying or selling financial assets. When a central bank lowers interest rates, it makes borrowing cheaper. Businesses find it easier to get loans to invest and expand.